that we want to point out. Unemployment rate recently moved up from 4.4 to 4.6. Hiring for November was above expectations, but still not very strong. About 64,000 added jobs positive, while October was a large negative number. So unemployment rate ticking up, raw employment, new jobs created, not super strong. GDP, we're looking at the estimates for the fourth quarter. We're looking at somewhere in the 1.4 to 1.9 range versus 2024. So again, below trend growth rate. Decelerating, yeah. But things like inflation. Inflation is at 3%, year over year, and on both the headline number and the core number, and it's been sitting there like a rock for over a year at that rate.
And historically, we've been closer to between 2
and
2.5.
The target, the Fed's target for core inflation is 2%. So we're obviously a full point over that, but we'll talk about that in a minute, because they're looking at lowering rates, and in fact did just recently, which is an unusual thing to do in times of higher than expected inflation. Certainly down quite a bit from the 2022, 2023 range, but still 3% is still a bit over target. But other things, and this is the offset to this. Corporate earnings this year have been absolutely outstanding. We're talking all of 2025, we're looking at 10 to 12% growth in corporate earnings. 2026, and that was driven, they say, primarily by tariff headwinds, consumers having a difficult time keeping up, especially lower end consumers. But 2026, as strong as 25 was, their expectation is 13% plus for 2026. So while the unemployment data doesn't look so great, corporate earnings growth, which really drives things like which way is the stock market going, is really quite strong. Some of this was on the back of, the stocks going up this year. It is on the backs of what they call the Magnificent Seven, the Mag 7 stocks.
And those are companies like NVIDIA, Microsoft, Amazon, Google, etc.
Yeah, exactly. The overall S&P 500 PE ratio, the price to earnings ratio, is currently sitting at 30. And it's been there all year versus an historical norm in the 16 to 18 range. 30 is very elevated.
Yep. And for those listening too, I'll just share, price to earnings multiple is just a metric we use for valuing a stock. For every dollar of earnings, it's how many dollars are you paying for the share price. So lower is better. And as Damon mentioned, 16 to 18 is more of your traditional average.
Yep. But if you take out the Mag 7, if you look at the S&P 500 minus those 7 stocks, instead of being 30, it's 21. That's
just
how big
those 7 removed.
Just those 7 removed drops the S&P 500 PE ratio by nearly 10 full points. So there's a lot of concentration in that area.
So I suppose some of the takeaways then, if you kind of are looking at all that together, is that valuations are higher than normal for the S&P 500. If you go exclude the Magnificent Seven stocks, as Damon mentioned, we're closer to normal valuation, still elevated, but not outlandish if you're at 21, 22 times earnings versus a traditional 16 to 18.
Yeah, and I think an important takeaway here is there's good reason to be diversified. Yes, the Mag 7 have had a spectacular year this year. Is that likely to continue next year?
It may.
It may. But if you've already got good profit, if you've made good money in those names, maybe start taking a little something off the table. Play with house money for a while.
Good time to rebalance, reallocate, and make sure you're diversified.
And in other news, the Federal Reserve just did another quarter-point rate cut earlier this week. Last week. No, this week. They just did another quarter-point rate cut. So they're looking at primarily, I'm going to say, at the unemployment rate rising as being a bigger concern for them right now than at inflation, which is stubbornly stuck around 3. I think they're leaning their mandate more towards the full employment side of the mandate than to the stable prices side of the mandate.
And again, for the listeners who sorry if you are familiar, if not, the Federal Reserve generally has two mandates. They're supposed to keep stability within employment, so you don't have too high of an unemployment rate and people can find jobs when they need them, and also keep the rate of inflation moderate so that your cost of living doesn't go up too fast. Very challenging to keep the two in balance when there's pressures on both sides. And so what Damon's making a point of is that the Federal Reserve has their hands tied right now as we're watching slightly higher than normal inflation, and we're also beginning to see very modest increases in unemployment. It's a juxtaposition for the Federal Reserve Board, and there were a number of dissents at the most recent meeting where they cut rates.
There were.
So it's going to be interesting as we watch heading into 2026. But one of the things that keeps us staying confident in the current environment is that even with slightly elevated market price to earnings valuations, we're still seeing, as Damon mentioned, extremely strong corporate profit growth and also embedded expectations for 2026. But I'll add, I think one of the main reasons for that is the already capital commitments to 2026 by some of the tech giants on continued AI spending, which is continuing to drive corporate profits and earnings. It's a bet. It's certainly something we're paying attention to, which is why we're watching the data as closely as we are. So as Damon mentioned, just to kind of wrap up on today's video as you near holiday times for you and your family, is just to keep in mind to always stay balanced, stay diversified. It's easy to want to take risks in the leading names, but it's a good time to look at your position, trim any that are slightly overbalanced or overweighted, potentially back to a more normal weighting, just to protect against any potential downside and risk or valuation for the long term. So thanks for joining us. And hope you and your family have a happy holidays.
Happy holidays, everybody.